It's 11 a.m. in London, September 16, 1992. The entire British government is currently in full panic mode. Inside these walls, the Bank of England is hemorrhaging reserves. They are burning £2 billion an hour, trying to prop up their sinking currency. In an act of pure desperation, the Chancellor of the Exchequer authorizes an immediate interest rate hike, eventually pushing it to 15%. Overnight, borrowing money becomes cripplingly expensive for ordinary citizens. But destroying their own domestic economy wouldn't save them. The government realized they were completely powerless to stop the man engineering the assault, George Soros. To understand how one man could hold a nation hostage, we have to look at the trap the UK had built for itself. 2 years earlier, Britain locked the pound into the European exchange rate mechanism. They signed an agreement to keep their currency pegged to the value of the German mark. But the two economies were moving in opposite directions. The UK suffered from high inflation and sluggish growth, while a newly reunified Germany was aggressively raising rates to keep its own booming economy stable. The IMF uses a metric called the real exchange rate. It dictates a currency must eventually reflect its actual domestic purchasing power. The UK government was bluffing against mathematical gravity, trying to hold a beach ball underwater. Soros positioned himself exactly where the break would happen. George Soros based his strategy on a specific philosophical engine, the Theory of Reflexivity. This principle suggests that markets aren't passive mirrors reflecting reality, they are mechanisms that actively create it. To force reality's hand, Soros and his team borrowed billions of pounds and immediately dumped them onto the open market. This massive wave of selling signaled to every other global investor that a collapse was coming, triggering a stampede of panic selling that fed directly back into itself. The dam finally broke at 7:30 p.m. Out of money and out of options, the UK government threw in the towel, withdrew from the exchange system, and allowed the pound to crash. In 24 hours, the Quantum Fund cleared over $1 billion in profit. Yet, by breaking the artificial peg, the market forced the UK currency down to its true value, setting the stage for more than a decade of uninterrupted economic expansion. 5 years later, the focus shifted to Southeast Asia. Thailand had built an economic miracle, transforming into a manufacturing powerhouse. And just like Britain, they made an inflexible promise, guaranteeing an exchange rate of exactly 25 Thai Baht to $1. Soros spotted the exact same structural flaw. He signed massive forward currency contracts, agreeing to hand over billions of baht months in the future in exchange for dollars. Commercial banks rushed to the Thai central bank to secure those dollars, draining the national reserves. By July of 1997, the Bank of Thailand had less than $3 billion left in the vault. They had to abandon the peg. Left entirely to the open market, the baht plummeted by half its value almost overnight. While the Quantum Fund harvested another $1 billion profit, the abrupt return to mathematical reality ignited a financial contagion that decimated the entire region. The fallout on the ground was catastrophic. Oil prices doubled. Major corporations declared bankruptcy. Within a year, millions of Thai citizens lost their jobs as poverty rates skyrocketed across the nation. The crash left literal monuments to the devastation. Dozens of luxury skyscrapers, bankrolled during the boom, were abandoned mid-construction to rot in the Bangkok skyline. The trauma altered the nation's financial DNA. Terrified of another speculative attack, the Thai government began hoarding hundreds of billions in foreign reserves. That was capital diverted away from domestic education and technology, causing their high-tech sectors to stagnate, while neighbors like Vietnam sprinted ahead. Decades later, the physical and economic scars remain. It forces a difficult question about the nature of global finance. When an entire society suffers, who actually bears the blame? When questioned about the human cost of his trades in 1998, Soros offered a brutally simple defense. He is there to make money. As a market participant, he claimed he cannot and does not look at the social consequences of his actions. The rules of exchange rates are entirely indifferent to human suffering. If a government builds an artificial economy that defies its own real purchasing power, that structure will eventually collapse. Speculators simply arrive to profit from the demolition. Attempting to dictate the absolute price of a free market currency is like trying to hold a pile of dry sand in a tightly clenched fist. The harder a central bank squeezes to maintain control, the faster the capital slips through their fingers. George Soros exists as a cold instrument of market physics. He is the speculator who identifies exactly where a government's illusion has reached its breaking point, and then positions himself to profit from the demolition.